So how to generate income by selling covered calls. So first of all, Bombardier on Thursday reached or surpassed $2.50. So it went over my strike price of $2.50. So the covered calls that I sold had a strike price of $2.50 and an expiry of December 21st. So on Thursday, when it surpassed $2.50, it's supposed to have sold automatically. Therefore, I would have made a capital gain of 25% plus the 4.5% that I gained from selling the covered calls, because I sold them at 12 cents. So 12 cents times 500 shares is $60 minus the fees. So I was left with $45 on a $1,000 investment. So that's 4.5% in 1 month plus the 25% I would have gained if the shares I owned sold automatically on Thursday, but it didn't. So I actually contacted Questrade to ask them why it didn't sell automatically, since the market price went over the strike price. Even on Friday, the market price went over the strike price. As you can see here, the day's range was between 226 and 257. So even if the market price goes above a strike price, it doesn't mean that your shares will sell automatically, because someone actually has to exercise the option. So when I sold the covered calls, I sold them for 12 cents. Someone bought them. So the person that bought them has the option to buy Bombardier shares, 500 shares of Bombardier at $2.50. That's what he paid for. He paid 12 cents per share for the right to buy Bombardier at $2.50 before December 21st. Once the stock actually went over $2.50, he has the option to exercise that option to buy Bombardier at $2.50. On Thursday, Bombardier reached $2.51. It only surpassed the strike price by 1 penny. So you would have had the option, the buyer of the call option would have had the option to buy it at $2.50 and sell it at $2.51. So obviously that's not a big incentive. But his other option is to sell the options that he bought. So he bought options at 12 cents and he could sell them at whatever they were trading at. And I believe on Thursday they were trading at 36 cents. So the person who bought options at 12 cents could actually sell them at 36 cents instead of exercising the option to buy the shares at $2.50. So by selling the call option that they bought at 12 cents, they could sell it at 36 cents. They just tripled their investment. In this case, it was a $60 investment. Had the possibility to turn to $180. Still triple investment in not even a week. So yeah, so now I still have the shares. They're at the bottom here. Still have 500 shares at $2. They closed on Friday at $2.40. So I'm up 20%. So now the issue with the fact that I sold the call options is I can't do anything to the shares until December 21st, unless someone buys the shares from me. So even if I'm happy selling the shares at $2.40 or even $2.50, I would like to sell it at that price. I can't do anything until December 21st. I have to wait because I sold the call options. I collected 12 cents for selling the call options, or 12 cents times 500 shares. So I collected $60 minus the fees, which is $45. So I collected $45, which is 4.5% per month on my investment. So I have several options. I can wait until December 21st. Hopefully someone buys my shares at $2.50, which is the strike price of my call options that I sold. In that case, I'm going to be really happy. I would have made 4.5% plus 25%, so about 30%. Now, if that had happened this week, I would have made 30% in a week. If it happens at expiry date, then I would have made 30% in 1 month. Now, come expiry date, my call options will expire worthless, so I don't have to do anything. I'll still own my shares. So I have several options. I could either sell my shares depending on the price that it's trading at. If Bombardier is trading at $2.50, I could probably sell it at $2.50. If it's trading higher, I'll sell it for sure. Or what I could do is I could keep holding on to the shares and then just repeat the process, which is to sell call options again. So I just So the ones I sold were December 21st. Come December 21st, when they expire, I could do it again and sell the ones for January 18 at a strike price of, it'll depend, of course, what the stock is trading at. But since the shares don't sell automatically just because the market price went above the strike price, I could probably choose a lower strike price or even the same strike price. So if the stock is trading at $2.50 at expiry date, I could repeat the process and sell January 18 expiry date call options. So with a strike price of $2.50, I could sell it at 32 cents. Now, right now they're worth 32 cents, but come December 21st, they're not going to be worth 32 cents. It'll depend on the market price. But let's say they're worth 32 cents come December 21st. So if I would repeat the process, I'd be getting 32 cents times 500 shares, 160 minus the fees of $15. So I'd be getting $145 divided by my $1,000 investment. I'd be getting 14.5%. So I got 4.5% the first month. Second month, I'd be getting 14%. I still own the shares, and I could keep doing that with my $1,000 investment. Now, I said I would be selling it at 32, but of course, come December 21st, this call option might not be worth 32 cents. It'll depend on the price or the market value of the stock at December 21st. It could be more, it could be less. But if come December 21st, the market value is $2.40 like it is today, then for sure it's not going to be 32 cents here, it's going to be lower. But let's say it's even 16 cents or 20 cents or even 25 cents, I'm still going to be making more than 5% a month by selling call options at that strike price. If the price is even higher, like let's say Bombardier is at $2.75 come December 21st and no one bought the shares that I own, well, I could either decide to sell the shares at $2.75, make my capital gain plus the 4.5% that I gained from selling call options the first time, or I could keep my shares and just repeat the process and sell more covered calls. So if it's trading at $2.75, I would have to look at a higher strike price. I could look at $2.75, and right now they're worth 24 cents. If I did it at if I were to sell the call options at the strike price of $2.75, let's say they're worth 20 cents come December 21st. So 20 cents times 500 shares, $100 minus the $15 fees. So that's $85. So that's 8.5% on my $1,000 investment. So first month 4.5%, second month 8.5%, and that's if it's trading at around $2.75 come December 21st. But it could also drop come December 21st. So if it drops, let's say it's trading at $2 or even $2.20 come December 21st, then most likely I'm not going to sell my shares. Most likely I'm going to repeat the process and sell more covered calls. So if it's trading at $2 or even $2.20, for example, I'm going to repeat the process with $2.50 strike price, and for sure this will not be worth 32 cents. It'll be much less. So even if it's worth 16 cents, I'd still be profitable. 16 cents times 500 shares, that's $80 minus $15 of fees, that's $65. So that would represent a 6.5% return per month on my $1,000 investment. So depending on the market price of the stock, I could keep selling every month covered calls. So worst case scenario, let's say I'm making 4% per month, which is what I made on the first month, times 12 months, that's 48% per year, which is way above my goal of 10 to 20% per year. And yes, that's just on $1,000. Now, of course, imagine if I had put all my buying power, which is right now sitting at 7,000, but my total buying power was about 30,000. In my margin account, my total buying power was 30,000. Imagine if I had put it all in Bombardier shares, and if I didn't sell covered calls, and if I had sold my stock at $2.50, would have made 25% on $30,000. which is 7,500 in 1 week. But of course, I would never take that risk. I would never put everything in one stock, because even though I am confident that Bombardier isn't going to disappear, I also believe that anything can happen. There's always a very small possibility that anything can happen. So I don't want to take that risk of putting everything in one place. So that's why I like to separate my investment and diversify. And hopefully all my trades are profitable trades. It ends up being the same thing. It just took longer and I end up spending more fees, and it requires me to find more winning stocks. But I'd rather do that than put it all in one place, and just I'd be way too stressed putting 30,000 in one stock. Actually, it's not about the 30,000. If 30,000 represents 100% of what I own, then yeah, I wouldn't be able to put it in one stock. But let's say I have a $1 million portfolio, then for sure I'm going to be putting $25,000 per trade. But it's just nice to see the possibility, the potential. Could have made easily 30% in 1 week. Bombardier was actually trading at $1.75 last Friday. So for those who bought it at $1.75, they'd be making much more right now if they held on until today. But knowing myself, if I didn't sell the covered calls and I had bought Bombardier at $2 and I could sell the shares whenever I want, I would have probably sold them already at $2.25. I would not have kept it this long. So actually selling the covered calls forced me to be a bit more patient when selling. And who knows, maybe it'll give me a potential to sell at a higher price. So if no one buys, the buyer of my call option does not exercise the call option and buys the shares that I own at $2.50 by December 21st, well then, depending on the price of Bombardier come December 21st, I will most likely sell the options which expired January 18, either at the strike price of $2.50 or even $2.25, depending on what the market price of Bombardier is come December 21st. So if it drops to $2, I'll probably sell the $2.25 strike price. So right now it's trading at 44 cents. So if I were to sell it at 44 cents, that's $220 minus $15 of fees. That's $205. That's 20% in 1 month. Something else I can do, which I did with Snapchat shares, is I could sell along a 2-year expiry date. So I could sell to January 15, 2021 call options, let's say at $2.50, trading, the bid is 74 and the ask is 185. So let's say somewhere in the middle, let's say $1.30. So I'd probably be able to sell that call option at $1.30 times 500 shares minus $15 in fees. So that's $635 that I would be getting on a $1,000 investment. But I'd have to keep the shares for 2 years. So it's actually 63% in a 2-year period. Unless between now and January 15, 2021, someone actually buys the shares off me at $2.50. Then I would have made my 63% plus my 25% from selling the shares. But from what I learned is it's not automatic that someone's going to buy the shares just because the market price goes over the strike price. Guess it depends on the volume of the stock. So I'm not going to do 2-year periods anymore. I'm going to keep it to 1 month periods and we'll see how it goes. See, there's another risk that if Bombardier is trading at $1.50, for example, come December 21st, then these call options are going to be worth much less. I'd have to reduce my strike price in order to have a decent call option premium. And the more I reduce my strike price, the less capital gain I make if ever the options get exercised and I'm forced to sell my shares automatically. So if Bombardier is trading at $1.50, for example, come December 21st, and I want to stick to a strike price that's higher than the price I bought the shares at, which is I bought the shares at $2, so I want to make sure that the strike price is above $2 so that in case my shares sell automatically, I'm not losing money. So if the stock is trading at $1.50 come December 21st, I'd have to choose at least $2.25 strike price, and this 44 cents would probably be worth 10 or 15 cents or even less. So then I'd have to look at a $2 strike price and hope hope that no one exercises the option to buy the shares, or hope that the price in 1 month does not go above $2. But as you can see, Bombardier is very volatile, so it could reach $2 in a month. I mean, you saw last Friday it reached $1.75, and already in a week it reached $2.57. So it went up $1. So it went up close to 50% already in 1 week. So that's how I almost made 30% in 1 week off Bombardier shares. And that's how you can generate income from selling covered calls on shares that you already own. So I'm excited to see what happens December 21st, whether I'm going to continue selling covered calls or if I'm just going to sell the shares, take my gain, and move on, look for something else. I'd be curious to know what you guys think. What would you guys do in this scenario? If Bombardier is trading at $2.50 come December 21st, would you just sell the shares and get out? Or would you continue selling covered calls? Leave your answers in the comments, of course. See, the thing is, as long as you're buying a stock that you're confident is not going to zero or is not going to go bankrupt, it's a great strategy because you can just keep holding on to the shares forever and just keep making a higher return than you would normally make by buying and selling. And you'll always own the shares. You could sell them whenever you want. And the longer you hold on to the shares, the higher it's going to go. So you could actually just sell it in the future at a much higher price. And in the meantime, you're collecting a decent return every month. So as long as the price of the stock does not drop below your purchase price, your initial purchase price, it's a very good strategy. So it's great with stocks that don't pay dividends, and it's even better with stocks that pay dividends because you have more of an incentive to keep holding on to your shares. So you keep collecting that dividend, you keep generating income by selling covered calls, and you'll always have the shares to sell whenever your call option expires. So yeah, of course I feel kind of bad only putting $1,000 in, but I have to stick to that strategy because I wouldn't be able to put everything in one stock because you never know what happens. Plus there's just so many stocks out there that I want to buy, so many stocks, so many buying opportunities right now. So I feel like I want to participate in everything, and it increases my chances, of course, of having positive trades. Like as you can see, all of these are positive right now. And of course I have a bunch of losing trades. I haven't sold yet, but they're in a loss position. Alright, so if you have any questions, leave them in the comments below. If you like my video, please like, share with your friends, and subscribe to the channel. And as always, if you can open an account with Questrade, use my referral code in the description below the video to get between $25 and $250 back, depending on your deposit. Thanks for watching.